Hi students, we're back and I have to apologize. The last video I ran out of time, and so we were covering brief exercise 12.1. I didn't quite finish it, so I'll start over from the beginning on it and we'll cover it and then move on. Lance Brothers Enterprises acquired $720,000 of 3% bonds dated July 1st on July 1st, 2021 as a long-term investment. Management has the positive intent and ability to hold the bonds until maturity. Now, that's the requirement to account for those bonds using the held to maturity method. Held to maturity bonds are accounted for at what's called amortized cost. So we amortize any premium or discount using the effective interest method. So the market the market interest rate or yield to maturity was 4% for bonds of similar risk and maturity. So the bonds are paying 3%. The market rate is 4%, so we would expect to sell those bonds at a discount. Lance Brothers paid $600,000 or a $120,000 discount. So they paid $600,000 for the investment in bonds and will receive interest semi-annually on June 30th and December 31st. Now, how much interest will they receive? Well, 3% is the stated interest rate, but it's semi-annually paid. So they're only going to get half of that at each interest payment period. So 1.5% times $720,000. So that's 10,800 if my math in my head is correct. $10,800 interest they'll get paid each interest payment period. Prepare the journal entries to record Lance Brothers investment in the bonds on July 1st, 2021, and record interest on December 31st, 2021 at the effective market rate. So the effective rate is 4%. So they'll record interest revenue based on a half a year at 4% per year, or 2% times net book value, which initially is $600,000. So $600,000 times 2% would be $12,000. Okay, now let's go look at the journal entries that are the solution here. And let me click there. So there we record the investment in the bonds. So the bonds have a face value or a face amount of $720,000. So we debit investment in bonds for that amount. We credit cash for the amount of cash paid, $600,000, and then the discount on the bonds is plug number to make those balance. So the discount was $120,000. Now, since it's a credit, it's a discount. If it were a debit, it would be a premium. Okay, so that's the entry to record the initial purchase of the bonds. Now, the payment of the interest on December 31st. First of all, they're going to receive cash based on the stated interest rate and the face value of the bonds. So stated interest rate was 3%. Remember, again, interest is paid semi-annually, twice a year. So we only get a half of the 3%. 1.5% times 720,000 gives you 10,800. We're going to determine interest revenue by the effective interest rate times net book value. Net book value right now is net book value is always going to be the investment in bonds minus the discount. So right now that's $600,000. So we're going to take $600,000 times the effective interest rate, which was 4%, divided in half because interest is paid twice a year. So that's 2%. So 2% times $600,000 gives us $12,000 in interest revenue. Now, the difference between the cash received and the interest revenue recorded is amortization of the discount. So we debit discount on bond investment for $1,200. And so now the discount is $118,800. And so now the net book value has gone up by this $1,200. So it's now $601,200. Okay, hope y'all understand that. Now let's go back to the textbook and we will move on. So now they get into the 3 ways of classifying debt investments, and I've mentioned those to you already. But right here we have held to maturity, and then trading securities and available for sale. Now, held to maturity, in order to be classified as held to maturity, then the investor has to have both the positive intent and the ability to hold the bonds until they mature. Unrealized holding gains and losses, in other words, if the market value of the bonds goes up or down, we ignore that. We record those and keep them on the books at amortized cost, which we saw just a minute ago in the homework problem. Now, trading securities are actively traded. In other words, they're bought with the intent of getting a short-term market gain and then selling them. And so they are recognized at fair market value on the balance sheet. And any gain or loss during the period is recognized in net income on the income statement. Okay, available for sale. And if I were listing these, I'd put available for sale in the middle because it's the middle category. They're not investments that you're buying to hold for the long term till maturity, but at the same time, they're not actively traded on a day-to-day basis. And so they're kind of a middle ground. You bought them with the intent of holding them for a while. And if the market goes up significantly, you'll sell them. If you need cash, you'll sell them, but you're planning to hold them for a while. And so they're again carried on the balance sheet at fair value. But the difference is that any unrealized, now unrealized means you haven't sold them and gotten cash. The unrealized holding gains or losses are recognized in other comprehensive income on the balance sheet. Other comprehensive income is closed out to accumulated other comprehensive income that we saw at the beginning of the first video. And it's shown in the owner's equity section of the balance sheet. So again, these are the middle ground. They don't qualify for either of these other 2 categories. So this is where they reside. Okay. Now, again, I always like to point this out when I see it because I don't want y'all to ever forget it. The primary purpose of accounting is to provide information useful for making decisions. Okay, debt investments accounted for as held to maturity. They, again, here are the qualifications: positive intent and ability to hold the investment to maturity. Investments are reported at amortized cost on the balance sheet. And amortized cost is amortizing the premium or discount using the effective interest method. Now, if we sell held to maturity investments before they mature, then at the time we sell it, we recognize any gain or loss on the income statement. Now, this footnote 4 down here is something really pretty important And I don't know if you can see that very well, but in cases where you actually sell held to maturity investments instead of holding them till maturity, that can cause some effects on your income statement, or excuse me, on your balance sheet. In that case, the company's held to maturity classification is viewed as tainted, and the company can be required to reclassify all its held to maturity investments as either available for sale investments, uh, and avoid using the held to maturity classification for 2 years. So, in other words, if you classify them as held to maturity, you better hold them to maturity. Okay, and again, here is what you would do to recognize the sale of the held to maturity investment. So you debit cash for the amount of cash received. You remove any discount or premium. So here they had a discount, an amortized discount of $28,703. So we debit that to remove it. We credit the investment in bonds to remove that. And then the difference is if it's a credit, a gain. If it's a debit, it's a loss. Impairment of held to maturity investments. You have to account for credit losses as permanent reductions. And you may remember the currently expected credit loss model that we talked about, where you get, we think there's a 70% chance of this happening and a 20% chance of this happening and a 10% chance of this happening, and you multiply all those amounts times the percentages and then add up those products. That's the current expected credit loss model. But credit losses have to be recognized immediately in net income. So that's kind of the point that they make in that section. Here it gets into the financial statement presentation of held to maturity securities, income statement, and the statement of comprehensive income. We recognize the gains and losses as shown in the income statement in the period in which the securities are sold. That's realized gains. Again, we realize them when we sell it and get cash. Unrealized holding gains and losses are disclosed in the notes of the financial statements, and investments in held to maturity securities do not affect other comprehensive income. Remember, they're recorded on the balance sheet at amortized cost. Unrealized holding gains or losses are not of any concern. Balance sheet, again, they're reported at amortized cost and less any allowance for credit losses. And any allowance for credit losses is immediately recognized as a loss on the income statement. Interestingly enough, if you recognize a credit loss and then in a subsequent period you think that credit loss that you recognized was too large, you can actually reduce that in a subsequent period. That's accounted for as a change in estimate. So in that period when the estimate changes, and in future periods. Statement of cash flows, buying and selling of them, is reported in the investing activities. Okay, our time is just about up. I will stop there and we'll pick up in the next video.